Janet Yellen recently made comments that you can see right here in this headline that she is taking steps to enhance the Treasury market and boost funds resilience. If we read between the lines here, this is the fifth or sixth time that somebody like Yellen has come out and said there is not enough liquidity in the Treasury market. Therefore, what we need to do is create some sort of government agency, pass some sort of new regulations or laws that deal with this problem. And really, they're skirting around the issue, and they're either talking about one of two things here. And really what I think they're talking about is the creation of a new central bank-like entity that give them the license to print money. Ready? Let's dive in. First of all, I understand my audio is absolutely terrible in here. It's what I have to make do with until we get this studio built out. Don't worry, this isn't how it's going to look or sound forever. It bothers me way more than it bothers you. All right, so Janet Yellen, recently she was talking to SIFMA, the Securities Industry and Financial Markets Association, and she made comments about the problems with liquidity in the Treasuries market. And now, I've made multiple videos about this for the last times that some people have made comments about this. And I said, hey, it looks like what they're trying to do is prepare the markets for a new type of agency to step in and be the buyer of last resort, the lender of last resort, because right now the Fed can't do that. So what's going on here? Well, normally the Federal Reserve steps in and they start up QE every time there are problems. And so interest rates are down, things are good. Then when problems happen and, inflation, they start raising rates. And then at some point that causes other problems. So they have to drop rates. And then, the whole cycle continues on and on and on. Well, this last time they actually did that a little bit too much, printed a few trillion too many dollars and caused heavy inflation, the worst inflation we've seen in 40 years here. And so as a result of that, the Federal Reserve has to stay the course and say, hey, we've got two mandates by Congress. One of them is full employment. The other one is price stability. And right now, prices are not stable. They're going up faster than they've gone up in 4 decades. And so they're saying, hey, we need to fight prices going up, which is trying to make the supply of money not increase as fast. Now, if we look here at what the Federal Reserve has done, the effect of their monetary policy since the beginning of this year, the total money supply has been moving sideways. So we have not seen an increase in the broad money supply this entire year. It's just been moving sideways. But that hasn't done much to stop the inflation that is a result of all of the prior money supply growth that happened up until this year. Now, eventually monetary policy catches up and it will impact prices, but it doesn't happen immediately. And so prices right now are still up year over year. I mean, a year ago, the money supply was still expanding up until, we'll probably get to the end of this year, beginning of 2023, when deflation really starts to hit hard. But in any case, the Federal Reserve right now is trying to maintain their credibility by saying, hey, we got to fight inflation. So when we look at this other chart that you are all probably very familiar with, is the Fed's balance sheet. They have to be dropping assets off their balance sheet. Now, these are primarily treasuries, which means that they are selling treasuries. And this is what Yellen is talking about here when she says there's increased volatility and illiquidity in the treasury market. And really what's going on here is nobody wants to lend money to the United States government. The United States government has 120% debt to GDP ratio. They have $100 trillion of unfunded liabilities. They've got just massive, massive spending issues going on here. And so nobody in their right mind wants to lend money to the United States government at 4% interest rate, especially given the fact that inflation is at 8, 9, 10%, depending on how you measure it. And so we are seeing a big funding problem come up for the United States government where they're saying, hey, nobody's willing to lend to us anymore because Bank of Japan, all over Europe, China, the Federal Reserve, all these institutions, big money printers that used to lend to the United States government, they're not doing that right now. So the borrowing costs for the government are going up. And really what that means is that every time they have to borrow money, they have to borrow money at a higher and higher interest rate. What that also means is that all the existing debt is going down in price, going down in value. Now, why is that a problem? Well, because you have something like this. About 9 months ago, the SEC starts talking about new regulations for money market funds. Money market funds, basically when you have money in your brokerage account or your investment account, anytime you have cash in there, that's in a money market fund. And so it allows investors to have access to a little bit higher yield while they don't actually have to invest the entire duration of something that's like a 2-year lockup period to get that higher yield, because you get a bunch of investors together. They all have their cash inside the money market fund. They take that cash and they deploy it in things like treasuries and T-bills. And then they give that interest back to all the people who are holding cash. And the money market funds basically just operate under the assumption that everybody won't take their money out of the money market fund at the exact same time. It's basically like fractional reserve banking. And so recently been talking about these new rules for money market funds to try and ensure price stability and immediate liquidity and reduce the issues that you might have with a bank run in a money market fund. Now, Janet Yellen recently said the exact same thing here. They're closely monitoring financial sector risks. And one of these is right here. She is talking about higher market volatility, exposing vulnerabilities in non-bank financial intermediation. So like shadow banking system, money market funds, things like that. Regulators have been working to reduce the first mover advantage that could lead to investor runs in money market funds and open-ended bond funds. Again, what's going on here is you got a bunch of investors together with cash. You deploy that immediate access, the on-demand cash. You deploy that into something that is not on demand, like a longer-term treasury or T-bill or something like that. And then you just hope that everybody doesn't ask for their cash at the same time. Because if they do, then you could have a bank run. You could have a stampede where everybody sells and the value just plummets, because then the money market fund has to go and sell all those treasuries. And if something like that is happening, then the value of those treasuries will tank because nobody's buying those treasuries right now, which is another way of saying nobody's lending money to the US government right now. And so when you have a situation like this and you have Janet Yellen saying we've got two options and we need to reduce the risk of a bank run on money market funds and treasuries, there's only two ways to do this. Option number one on how to do this is to close the gates. And so this is similar to how Nixon stopped the bank run on the US gold vaults. All he did was he said, we're not going to give you gold anymore. So that's what that first mover advantage is that she's talking about. It's whenever there's a potential bank run, there's an incentive for you to be the first one to sell, because then you're guaranteed to get what's owed to you. If you're one of the last people in line, there may not be anything left. They may close the window. They may not redeem everything. And so that first mover advantage is basically the dynamics of a bank run, where the first one in line gets everything that they asked for and the last one doesn't. And so there's the incentive to make that bank run happen by trying to be the first one in line there. So in order to reduce that, you basically have to do one of two things. Number one, you can just close the window and say, no, redemptions can't happen, which would cause the bank run. You'd cause all types of problems. And I don't believe that that would ever happen. I don't think they're dumb enough to go that route. Let's just hope so. So the other option here to reduce that is to make sure that prices don't fall. So when the Federal Reserve was first started, it was started under the guise of trying to stop bank runs, because for a few decades there had been a problem with panics and bank runs and things like that. It wasn't as widespread as people make it sound like today. It was actually a pretty rare occurrence. But in any case, if you had a bank run, everybody went to go get their gold. The gold wasn't there. So the central bank was started, which was to be a bank for the banks. So if one bank had a bank run, they could just pull gold from the central bank and redeem all of the claims, and they would no longer be fractionally reserved at that one local bank, because they could pull from the gold from the central bank, which was pulling from the gold from the other banks. And so if you go and you suspect that your bank doesn't have all your gold and you go to get your gold out and they say, yep, fully transparent, we'll give you as much gold as you want. And then the second person, third person, fourth person will give you all your gold back. Well, if they're able to do that and prove that they can do that for everybody, the bank run stops, because there's no reason to have the bank run. Because the only reason to have the bank run is because you don't think they can redeem it. And so it eliminates the reasoning or any incentive for the bank run to happen if the fully redemption at the full price is possible. Well, the only way to do that with treasuries, where you have a money market fund run stopped, is to stop the price of those bills, those treasuries, that government debt from falling. Now, let's go back here to the Federal Reserve's balance sheet, and the Federal Reserve is selling because they're combating inflation. Well, The only way to stop prices from falling is to have buyers that are matching the sellers. And if everybody is selling, then the only person who can buy enough to stop the prices from falling is the infinite money printer, which is the Federal Reserve. But they're selling also. So who's going to buy? And that's what they've been talking about here. We're looking at ways to improve resilience, make sure intermediation is available. And I've talked about in past videos, starting new government regulatory agencies that are not the Fed to step in and be market makers and provide liquidity. Well, the only way you can do that is with a license to print money. So maybe they change the rules and allow banks to hold more treasuries, own more short-term debt to come in and be buyers and give that license to print infinite money that the Fed has to banks. Maybe they start a new agency that has some of those same powers. But in any case, that's exactly what's happening. That's the bottom line. When you boil it down to the basics, you unlock a new money printer that comes in and buys an infinite amount, a potentially infinite amount of what's being sold to stop the price from falling. It's just supply and demand. And so if the supply of sellers is overwhelming the demand of buyers, and that's pushing the price down, the only way to stop that from happening is to have an equally matched buyer come in who can buy an unlimited amount to match all the sellers to make sure that that price doesn't fall. And that buyer will say, no matter what, I'll always buy up here at this price. Now, ironically, if they were able to do this, it might mean that they never have to use it because, like I said in the bank run, if you know that your gold is there and you can redeem all your gold anytime and it's 100% safe, even if it's being pulled from somewhere else, that eliminates the incentive to start the bank run. And so if they are able to start a new money printer here outside of the Federal Reserve, then that might eliminate the need to actually use that money printer. But probably not, because we all know that when the government gets a taste of a little bit extra spending with no consequences right away, a little bit more purchasing power, they're able to borrow a little bit more with no consequences of rates going up because now they have a new money printer there to lend them the money. Man, we've entered into full-blown MMT, and we know that their appetite for spending will explode on that, and we don't have to sacrifice the credibility of the Federal Reserve. The Fed can keep on fighting inflation with the slight reduction in their balance sheet, while at the same time the government is borrowing and spending hand over fist from this new money printer. It boils down to full-blown MMT, just printing money to finance all expenses. It's no longer debt. So that's what's going on here. It's another sign, another signal, another flag saying, hey, this is what we're doing. And I made a few videos about this already, like I said, but I wanted to let you know, hey, it happened again. She mentioned it again, talked about it again. I would not be surprised to see something like this start, or at least the foundation for it be laid, so that when it's needed, if we have some sort of a panic, they're ready to go to fire up that new and improved money printer. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.